The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Jay Powell there signaling when the Fed may start cutting rates. He's talking as soon as September. We're now just half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Yeah, let's get to your top stories today and hopes for a Fed rate cut soon, sending Asian stocks broadly higher, although as you can see, the Nikkei 225 is pulling the benchmark down. Perhaps has to do with the yen, which is surging to March highs against the dollar, punching through the 150 handle. Now, Chinese stocks in focus this hour with the onshore gauge capping its best day in 6 months, and optimism about government stimulus. And the U.S. is said to be considering unilateral restrictions on China's access to AI memory chips, further escalating their tech rivalry.
All right, we're getting that boost from those comments from Jay Powell, the BOJ as well. But certainly we're watching this Treasury market very closely, just given the double-digit drop in yields across the curve. Post-press conference from Jay Powell, the statement itself from the FOMC was actually quite marginal. It was really what Powell mentioned in that press conference about maybe a bit more of the time frame here of when rate cuts could be coming is really what spurred this Treasury rally that we've seen. We talk about what's been going on. So you have the 2s, the 5s, and the 10s are at 6-month lows for those yields here right now. The 10-year dropped the most in 2 months, basically after those comments. And we have a steeper yield curve for the 5s and the 30s here this morning, the steepest we've seen since May of 2023. And now markets are pricing pretty much a full 3 rate cuts by the end of this year. Treasuries, there you go, capping a third straight month of gains, the longest winning streak we've seen for U.S. bonds in 3 years. That sent the dollar dragging and, of course, the yen flying as well. We talked about the highs we've seen for yen since March. That is thanks to, of course, that hawkish BOJ, dovish Fed sort of dynamic there. We mentioned about breaking below 150. We are still staying at those levels here right now. The BOE is next as well. The pound is a little bit on the back foot there ahead of that decision as well. And we're watching very closely what big tech does, because obviously you saw double-digit gains for NVIDIA overnight as well, given that there's been a relief across some of these tech traders out there as well. There you go. Taiwan Semi is up some 3%. That's really helped lift the TAIEX by about 2% here. You know, the only market to worry about maybe is Japan today, just given the strength of the yen, right? We're down about 2.5% this morning, but yields across sovereigns here are basically heading lower. And we're watching oil markets, right? So escalating tensions in the Middle East. You have Iran now, threatening, according to some reports, retaliation against Israel after that strike in Beirut. So certainly we're seeing oil prices, we're seeing $81 for Brent. Shanghai crude is up about 2.5%. Metals also were boosted yesterday after that weak PMI data really boosted hopes that maybe Beijing might start ramping up stimulus. And that really sent us to more of a rally in equity markets in China, right? We talk about the CSI 300, best 6 months that we've seen in that session yesterday. Renminbi as well. We're heading for the best month this year for the currency, really, but lifted by the yen, the drop in the dollar as well, 721 levels. And yeah, CGB is still slightly bid up here this morning, Dave.
Yeah, there's going to be slightly more give when it comes to the fix today out of the PBOC, given this drop in dollar, everything almost going into the session today, about 26 minutes away. But of course, Fed Chair Jay Powell, of course, hinting that rate cut is her central story today. We're looking at possibly now September. Take a listen.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. We have made no decisions about future meetings, and that includes a September meeting. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Yeah, and certainly markets ran with the dovish side to the conversation. And keep in mind, though, right, between now and the September meeting, you still have 2 inflation reports, you have 2 job reports. As things stand, though, September is more than priced, as you can see, 30 basis points there. All things equal, by the end of this year, we're looking at closer to 3 cuts now priced. You have 3 remaining meetings there. Of course, let's bring in Seema Shah, Chief Global Strategist at Principal Asset Management, joining us out of Singapore today. Seema, first, it's nice to see you in the region. Good morning from Hong Kong. Thanks for coming on the program. Closer to 3 cuts now priced. Do you think equity markets to be specific, will need 3, or do you think 2 will be fine for now?
Good morning. Thanks for having me on. Well, look, I think if we're looking at 3 rate cuts this year, the chances are that probably implies that the labour market is weakening more than the Fed wants. So actually, I think the best case scenario is that we do get the 2 cuts that certainly we have been expecting, so September and December, but that is sufficient to maintain strong labour markets and therefore a soft landing.
So I'm just wondering, is this sort of the sweet spot, you think, for risk assets right now? We're getting a little bit more clarity from the Fed that maybe September, that cut is coming. How do you see things playing forward for stocks and bonds?
Yeah, this is currently the sweet spot. This is where you have the market expecting rate cuts, but it's not accompanied by significant economic slowdown worries. So if this is maintained, then that really should be a positive path for risk assets through to the end of the year. We've already seen bond yields drop very significantly. I mean, almost down to 4%. So that should also be another benefit for equities. The thing is that we need to keep an eye on earnings. That's going to be the key driver as soon as attention starts to move away from what the Fed policy path is. So as long as that can be sustained, then it should be a fairly strong second half of the year.
Yeah, and Seema, since you brought it up, what do you make of the earnings season so far? It's been a very big week, and of course we don't have NVIDIA yet for another 3 weeks or so, but so far so good, or fill in the blanks?
I actually think it's so far so good, and I think it's a slight continuation from actually what we saw in last earnings season, where you had seen a broadening out of both investor sentiment but strong earnings growth. This is something that we've been anticipating, and it should happen given that the economic backdrop is still fairly solid. I think for mega cap tech, that of course has been the biggest question. But the good news is that with that broadening out, the market is paying attention, which is why you've seen the small cap stocks do so well. And you're seeing the other sectors, financials, industrials, all doing fairly well.
So I'm just wondering if it's 2 is more the sweet spot for risk assets, 2 cuts I should say. I mean, what does the next year bring, right? Because everyone's still thinking maybe we could see a rate cut every meeting. Is this going to be a pretty deep sort of easing cycle or more of a shallow one, just given the economic strength that you've been talking about?
Yeah, and actually I think that is a bigger question, more than just when the timing of the first cut comes, is what does the overall cycle look? So for us, because again, as we're expecting the US to avoid recession, that should only imply about 3 to 4 cuts next year. If you do get that scenario of 6 to 7 cuts that the market has been pricing, that should actually be fairly bad news for the market, because it would imply that the economy is struggling, the labour market is unravelling, and then the fundamentals of earnings growth starts to look a little bit more negative. So actually the sweet spot for us is not just 2 cuts this year, but then a very, very gradual pace of easing. So 4 cuts, 3 to 4 cuts next year, I think would be a very, very positive backdrop for risk assets through 25.
Yeah, Seema, in fact, we were just looking at the SOFR curve. 2 years out, the Fed funds rate seems to be still above 4%. So, I mean, that's hardly an aggressive easing cycle, to your point. How does that affect asset allocation choices between, say, and now and over the next 2 years or so, between stocks, bonds, and everything in between?
Right, so when we're looking across our asset allocation space, at the moment we're still very much overweight equities, and that's over a kind of a 1 year to 18-month horizon. For fixed income, it's still fairly risk-on. So it's mostly focused on the credit part of fixed income, investment grade, high yield, but even within high yield, still focus on quality, because, of course, we do have a slight slowdown coming through. And within equities, look, the US market is looking strong. But there are increasingly opportunities outside of the US where valuations haven't been as stretched, and where you could see parts of the world actually benefit from what happens in the aftermath of the US election as well.
And you talk about, one of the main risks is staying in cash right now. I mean, is this the time you think that, investors are really going to start deploying that dry powder, that we've gotten a bit more clear runway of what's going to happen in the next 6 months or so?
Absolutely, and that time is really running out because the reinvestment risk is rising the closer and closer we get to that Fed cut. So this is the time that investors need to start thinking about which parts of the risk asset spectrum can stand to benefit in an environment where you have rate cuts accompanied by softening but still positive economic growth. And for us, actually, there's opportunities everywhere. Within equities, as I said, there's opportunity within the US in different pockets across the rest of the world, outside of just that mega cap tech space, certainly. And then within fixed income, the credit market looks good. And of course, if you had concerns that the economy is going to decelerate more than we are expecting, then fixed income gives you that downside protection. The other thing that I would point out at this stage is that if you do get those Fed cuts coming through, but the economic backdrop is still strong, there is still that risk that inflation takes off again. So inflation mitigation has to be a core part of any portfolio at this point in time.
Yeah. So what would be the pain trade right now, and what triggers that?
So I think the concern would be if the economy really starts to slow down more than expected. And certainly there are risks. We look at the labour market, and so far we haven't seen any job losses or major job losses, and that rise in the unemployment rate is mainly down to labour supply. But it does seem that we're getting close to a tipping point where if there were to be a continued weakening in the economy, that could start to unravel. That's why it's important that the Fed goes quite soon. But if the economy did start to decelerate, then unfortunately the earnings growth backdrop starts to also deteriorate, and the picture does become quite different across the equities and fixed income space as well.
Seema, nice to see you. Sorry, I was about to sneak in a question there. Yvonne and I just wanted to thank you collectively for nice to see you in the region. Of course, Seema Shah, Chief Global Strategist at Principal Asset Management. All right, the sell-off that's taking place in Japan. Wow.
Yeah, I mean, a 3% loss here when it comes to the Topix on the back of what we heard from the BOJ. So that yen strength really playing a big part in what's dragging the stocks in Tokyo here this morning. This is the biggest drop we've seen for the Topix since February 2021. So biggest drop in 3 years for that gauge as well. Dollar yen still holding below that 150 level, 149.15 this morning.
Right, just ahead here on shows, BYD and Uber are looking to put up 100,000 EVs onto the ride-hailing platform, but the rollout won't include the U.S. Shares of BYD soared overnight. We'll look at what happens, of course, as we approach the open today. Details just ahead on that story and counting down to the open of trade. And we're coming off the best day in 6 months on the CSI 300. Futures are flat ahead of the Thursday session. This is the China Show.
All right, your renminbi fix should be out any second now. And there you go, 713.23 here this morning. We continue to see that strength play through for the currency. You got to thank the BOJ for that in some ways, but you got to wonder how long can this renminbi last? The dynamics with the yen and the renminbi are very, very different here right now. Yes, it's sort of that unwinding of that carry trade that's happening, but the fundamentals are obviously very different too.
Yeah, well, one is hiking, the other one, we're going to get more cuts. Plus, one is faced with potentially higher tariffs ahead.
Yes.
Ahead too. That takes us into the agenda today because when you look at the rally in the bond markets, right, so at 213, 214 right now, and we have several pieces out on the Bloomberg that talk about what specific indicators to watch, if not levels to watch, that might precipitate officials coming in and maybe cooling this rally even further. Sector-wise, in terms of what happened yesterday, so chips on the back of news overnight, which we'll get to in a moment, plus, of course, that massive rebound in the likes of NVIDIA, for example. Energy, you know what happened with oil prices. In fact, I'm now looking at oil as we speak right now. Shanghai oil is up. I'm just looking at my price right now, up 3%. So look at oil. Healthcare did very well in the session yesterday, so keep an eye on that too. BYD, We talked about that story and that partnership with Uber. And of course, we have some data coming through in the form of, well, many things. You have PMI data. This is the private survey. Hong Kong retail sales, where we are expecting a fourth straight monthly contraction, year on year, by the way. This is for June. And of course, casino revenue comes out later today. But yeah, it looks like we might get a rally yet again, continuing. Okay, now on the chip story too. So the U.S. is said to be considering new restrictions on China's access to AI memory chips and also equipment. That's a move to further escalate this tech rivalry. Min Lo joins us here out of Hong Kong, of course, our China correspondent. And yeah, what do we know about what is possible?
Yeah, so these new set of restrictions are targeted at the most cutting-edge chips for AI. So these are the HBM, the high bandwidth memory chips that are required in AI accelerators offered by companies like NVIDIA. And the most dominant companies in making these HBM chips are Samsung, SK Hynix, Micron, for instance. And if these new rules are enacted, then these companies will be prevented from not just selling their chips, but also selling those tools required to make those chips to China. Now, it's not clear yet how Washington plans to impose these restrictions, but one way is to invoke the Foreign Direct Product Rule, FDPR. That's a way for Washington to impose controls on foreign products that rely on even the tiniest bits of American technology. And we know SK Hynix, Samsung, they still rely on U.S. chip design software, for example. Micron is less likely to be affected because they have largely refrained from selling these HBMs to China after Beijing had banned Micron from critical infrastructure. And this is all part of a broader push to curb China's technological advancement by also imposing sanctions on over 120 Chinese firms by designating them as a national security threat in an entity list. And the Biden administration also wants to create a list of restricted components, critical components that China will need to make semiconductors as well.
And we're told that the U.S. may consider some exemptions for some of their key allies, whether it's Japan and Netherlands.
Yeah, so this was first reported by Reuters that the U.S. may consider some exemptions, and that's why we are seeing companies like Tokyo Electron, ASML, those stocks jumped yesterday. But some experts are warning that investors could be mistaken in bidding these stocks higher. They're saying that these exemptions could be there because these are the companies that are very likely to align with the U.S. anyway without the need to invoke the FDPR. And the fact that Washington has the power to impose this FDPR rule sometime in the future to punish companies that veer too far away from U.S. policy. That's always a shadow that is kind of overhanging, you know, on these companies. And there's also the flip side where the FDPR could backfire if it incentivizes these companies to bypass American technology and rely on other sources of technology in their supply chain as well. And of course, there's also pushback from these companies who still see China as a very important market. So there's a lot of consideration here, and I think we need to wait and see what the final package will be because it's still very fluid at the moment. Sources are saying that nothing is still finalized at the moment.
Yeah, and whether some of these Korean firms like Samsung are going to abide by this as well. Min, thank you. Our China correspondent Min Lo there on the latest on that Bloomberg scoop as well. We're taking a look when it comes to the approach to the open here. Looks like we are set to continue this massive rally that we saw yesterday when it came to some of the onshore and offshore stocks as well. We're still trying to figure out what kind of led to this, right? Because as Dave mentioned, if you take a look at some of these ETF flows and some of the ones that these state funds had targeted before, didn't get even that much support from the state here as well. But futures are pointing pretty flat here this morning, and we're watching continued strength when it comes to the currency, putting more ahead. This is Bloomberg.
Okay, just the momentum going into today. In case you missed the rally yesterday, a substantial one on price. So CSI 300 was up over 2%. Every single sector was up with the exception of utilities, a classic risk on. And it actually took place against the backdrop of what seemingly looked to appear like a pullback in state support as signaled by lesser flows into these ETFs that track these large cap indexes like the CSI 300. So we'll see if this continues going into the Thursday session.
Yeah, let's get to our Asia stocks reporter John Chang. He joins us from Singapore now. And you know, John, what do you think was really driving this rally?
So the bounce yesterday we saw was a combination of different factors. First of all, traders were initially disappointed with the Politburo statement, which sort of stopped short of offering any strong stimulus measures. But after one day of digestion, some of them are sort of adopting the glass half full mentality, expecting more stimulus measures to come in. That's especially after another set of weak eco data we saw yesterday. And also, you mentioned there's a slowdown of national team activities, but we still see some activities in that space, and that's sort of putting a floor on sentiment. And also maybe there was some sort of short covering as well, so that really helped drive the bounce in Chinese stocks yesterday. But whether that rally can be sustainable, it remains yet to be seen.
Yeah, well, what can we expect from here on, John?
So I think one key thing would be whether there are more, support measures from Beijing, and whether that's in terms of triple R cut, whether in terms of LPR cut or more fiscal measures. We really need to see more stimulus measures from the government, and that's one thing. And also, we really need to see that local consumer sentiment turning around. Domestic demand has been weak. The property market is showing few signs of improvement, and all of that is really weighing on sentiment for global investors. So we really need to see some sort of improvement on that front before people can have a little bit more conviction in the market. And also, as we enter into the second quarter earnings season, this will be a key time period for investors to gauge whether there are more, solid rebound in terms of earnings revision. And so far, the data we've been getting aren't looking great. So, we'll see if when the individual companies report how their results are going to look like before people will decide on the short-term outlook for Chinese market.
John Cheng in Singapore for us, our Asia stocks reporter. And in a couple of minutes, we'll be having Wendy Liu, of course, out of JPMorgan to talk us through their calls on this Chinese equity market. Going into the open today, we've now erased the early tailwinds right now, 0.1% to the downside. So it looks like we're going to give back some of the gains from yesterday. Not a lot, the 0.4% on the HS Tech Index here.
Yeah, in terms of analyst actions to tell you about here today, we're focusing a little bit more when it comes to the consumption space. China Resources Beer raised to outperform, and Macquarie here, Hang Lung Property cut to add at CITIC Securities, of course, after that dividend cut and their earnings, and Hang Seng Bank as well cut to underperform at Jefferies here. In terms of stocks to watch, we're watching New Oriental Education. So those ADRs tanked yesterday after the first quarter net revenue forecast missed analyst estimates. We're seeing already some downside here in the pre-market, about 7% down. The stock has been under pressure, right? There's that impact also from East Buy after that live stream celebrity streamer also left the company as well. But yes, you have the likes of JPMorgan, Morgan Stanley also cutting the price targets for the ADRs following those results. We're also looking ahead to, of course, Budweiser reporting earnings later on today as well. Watching those property shares, we got some new home sales data that came out that didn't look too pretty either. We got the open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're counting down the open of markets. And of course, we've been questioning kind of what led to this massive rally in Chinese stocks yesterday. It looks like we're pulling back just a little bit. But yes, broadly speaking, we are taking a look at risk assets, and they are doing quite well post-Fed as well, after we heard from Jay Powell basically signaling, really laying the groundwork that, September cuts could be coming. Markets are now running with it here this morning. But yeah, not so much when it comes to Greater China. But yes, the strength of the currency, though, and the renminbi still holding pretty strong. We're at 721 levels right now, best month that we've seen since all year, basically.
Yeah, that tracking the yen, which semi-useful trivia for you guys. July was the 6th best month for the Japanese yen this millennia. Anyway, we'll show you what's happening with the Japanese market, by the way. So that seems to be getting a drag from the strong yen. In a moment here, the open in onshore is we're looking like at a flat open, as Yvonne is pointing out, the best day in 6 months. Every single sector, with the exception of utilities, caught a very strong bid. And it's looking like in the early going, some people are taking money off the table in consumer staples. Moutai and some of its peers are down. Interestingly enough, though, Midea, which is an appliance maker, is still catching some upside right now. So that did catch some substantial upside yesterday. Hong Kong, the open today, and while you look at this too, the data on real estate is still wanting. Negative 20%, the top 100 developers combined sales for July. Right, Hong Kong, in terms of data coming through, a PMI in about 15 minutes, retail sales out at the close, and the casino revenue should be out at about lunchtime today. Tencent, 0.8%. Baba is still catching a bid, albeit quite a modest one at that. And of course, just in case you missed it, no change in the interest rates here in Hong Kong, following what the Fed did or did not do overnight. Right, a couple of stocks to track. BYD up overnight. This partnership with Uber. We should see some upside there, if I'm not mistaken. There we go, 0.5%. CNOOC on the back of this move up in oil prices. New Oriental, 15% down now in the early goings. Miss there as far as revenues go. And of course, we talked about, yeah, there we go, 0.5%. Right, as promised, Japan is doing quite badly. 3% drop. I think over 200 stocks on the Nikkei are actually down. Real estate is taking the biggest hit in Japan right now on the back of, I would imagine, prospects of not just a rate hike, right? Our guys at Bloomberg Economics think another hike is on the cards out of the BOJ in October. And dollar-yen is down. The yen is up against every single one of its peers this morning. Back to China very quickly, in case you missed it. Big pop on the CSI 300 yesterday, up 2%. And our chart shows you this. And that took place, by the way, seemingly on the back of this pullback in state support, which is your first panel, lesser inflows into these ETFs. So it just could be the markets are running with this story.
Yeah, let's ask that question to Wendy Liu, Chief Asia and China Equity Strategist at JPMorgan. What do you think is driving all of this right now and this optimism yesterday?
I think it's the Politburo meeting that became more specific on where the issues are. And I think those are the issues that market also agree with. Consumption on the weak side, overcapacity, excessive pricing competition. And then lastly, economic and non-economic policies are not always headed in exactly the same direction. And so since Spring Festival of last year, these audits and anti-corruption, potential clawback of compensation in some parts of the financial industry have really dampened business and consumer confidence. So for these issues to get raised at the Politburo session, I think people feel like, at least what the challenges have been are now being recognized.
Right. At least they're being talked about now. And it's going to take time before the issues go away, before earnings recover, before the economy starts to respond. Do you think markets can ignore the reality for now, the next few months, while on the back of potential policy tailwinds that you rolled out there?
I think the market's waiting for specific policies. It did respond. And I think on the consumption side, the better buy could be on the services. The equipment or the appliances did do well, right? And I think the earnings season could give us some support. And if we look back to March and April, it was really policy, housing policy specifically, and then earnings coming through, then flows changed. So I think we're at a more favorable point than where we were in July.
I was going to get your take on, you have something in your report that where we are in this cycle, right? You take a look at what MXCN is doing. You're saying it appears to be looking like the Topix during the late August of 1997. Walk us through some of the parallels that you're seeing, and what does this all mean?
Yeah, I think tactically, August is better than July. But if we look at the longer-term picture, when we match the standard deviation to 10-year rolling 12 months PE, then it looks like MSCI China is August 97, and this is where there's still credit issues to be sorted out. Right. There were 4 financial institution failures in Japan in 97, and then ultimately by 98 there was recap, there was capital market opening, and then you had inflows coming back. So I think it's very much some of the items that get mentioned about further reforms and openings, so we're in that process. So now Topix in and of itself back then had more downside from August 97. Right. And the best performing sector was utilities. Okay. and which happened to be the sector that turned out to be the most resilient during the U.S.-China trade war from 2018 to 2020.
Right. So is that the barbell strategy then?
Yes.
Utilities is one, and what's on the other end of that strategy?
The valuation on Chinese equities is really cheap. One standard deviation below 10-year mean on PE basis. So the other side would be GARP, growth at reasonable valuation, and some thematics like the industrials parts of it, locomotive, heavy-duty trucks. They're definitely benefiting from the upgrade cycle. And then AI, we'll come back to AI. We've been positive since September last year, but I think it's taking a bit of a pause, but in due time it will be quite good again.
You're still focusing on these high yielders, the dividend plays. We've seen some wobbles in the last few weeks or so, given maybe, I don't know, whether you can really look at these sort of stocks as safe havens or not. We've also seen a lot of volatility in the bond market and this rally and falling yields there. That might dent the appeal of these dividend stocks, but why still stick to this sort of trade?
I think in the portfolio construction, you get returns from earnings growth, we get returns from dividend, and so this is where things are relatively stable. Now, to your point, the bond market has been a bit volatile. The mixed funds, blended funds onshore, they can buy both bonds and equities. They've been a marginal mover for the high yielders. So if the anticipation is more bearish on where the yield could go, then they could shift to bonds vis-a-vis the high yielders. So I think that's at play. But in and of itself, I think they represent stability in a portfolio during a time with volatility.
Yeah. Speaking of alternatives, how much do you think the weakness onshore, specifically in the Asia market, is down to, for one, the bond market is doing very well. Another is you're just getting a lot more high yield offshore, Hong Kong and elsewhere. How much of the external factors is affecting what's happening onshore?
Good question. I think the retail has just been parking their money in banks and deposits. So the interest among retail to buy equities has yet to pick up. There are inflows into the high-yielding dividend funds. So that's where we see the inflow. And I think the typical retailer may have bought a little bit more small mid-caps than large caps, and large caps have outperformed. So the actual return experience is a little bit worse for the retail, and that hurts the sentiment also.
How much does the Fed story change the dynamics? Obviously, we have a U.S. election that's looming. Do you think are those going to be bigger drivers of Chinese stocks than the domestic economy right now?
It depends on the time frame. So there are time frames where the policies are coming through, earnings coming through, and flow will be better. I think there's a rotation within Asia or APAC where certain markets would outperform on a quarterly basis or half quarter. So you saw Q1, Japan outperform, first half of Q2, China outperform. Now, on the U.S. election risk, that was brought to the fore in the month of July, and I think it'll come up again, and with trade and tariffs being in focus. And the next date we're watching at is the Democratic convention, which is over August 19 to 22nd, and subsequently the debates around first half of September. So we tend to see it as a bit more event-driven. The market will focus on those issues. The here and now, so kind of have to recalibrate it every month in the next 4 months.
Well, watch Bloomberg every day. You'll get an update on that.
Every second.
You mentioned earnings. Where do you think we are in the revision cycle in earnings? I mean, we had positive revisions, I think, April and May. Or May and June, but do you think we've turned the corner? And the reason I ask you that, I want to get your thoughts on this drop in consumer staples, right? The Moutais of the world, and concerns that the earnings there might not be too good.
Yeah, I think the overall earnings cycle for MSCI China is actually very positive. But there are 3 sectors where we see wobbliness: healthcare, financials, and staples. And that's where we could sense from the quant data that there's non-economic policy measures at work. Healthcare has recovered a little bit, and financials and staples were still in that, sort of a troughing process. I can't comment on specifically
of course,
on the single stocks, and I think it's partly about supply and pricing, and it sort of alludes to too much capacity, output, and then weaker pricing. And then on the consumption side, the business consumption, government consumption has also been taking a hit because the business confidence has taken a hit and people are not investing as much. So I think that's where we are right now. So I think household-related, service-related areas would be better. So we do like travel, we do like after-school education and proxies in that area, and then also gaming and entertainment.
Fantastic. Wendy, always a pleasure. Solid insights as always. Wendy Liu there, Chief Asia and China Equity Strategist at JPMorgan. Right, just ahead here, we hitch a ride in a robotaxi, but it's not all smooth driving as the technology sparks some anxiety in China. Who wouldn't really with this view? Details next. This is Bloomberg. Right, we're checking in on shares at BYD, down 0.5%, so not quite reflecting the move up overnight. The story here, of course, is Uber will be teaming up with the company to put 100,000 EVs into the company's platform, the ride-hailing company's platform to be more specific. The tie-up will start in Europe and LATAM, and notably does not include America. Danny Lee, our Asia transport reporter, is here with us to talk us through the tie-up, two big names coming together. How significant is this?
Yeah, the volumes here in this deal is worth 100,000 units, but all this means for now is BYD offering cheaper EVs and preferential financing, and this will go into its key markets it wants to expand outside of China into, which is Europe and Latin America. And then the deal will involve going to markets such as the Middle East, such as Canada, Australia and New Zealand. So it's a baseline for expanding more aggressively, getting their brand out there into more markets as possible. And who could you think of a better partner in Uber, right? Which does all of this ride hailing. And so for Uber, this is also an important deal because of its targets to get to net zero by 2040. But it's also just fascinating for BYD because it's expanding and all the barriers and the tariffs that are being put up in markets around the world, especially in Europe. So this is a interesting deal at an interesting time.
And BYD, they're also knocking on the door of expanding in Canada. I mean, this is as we start to wait what the Prime Minister might do is maybe lining up punitive tariffs on Chinese EVs. What's going on?
Yeah, it's maybe better late than never for BYD to try and intervene. And we know this because it's hired a lobbying firm to engage with the with Canadian officials, the Canadian government, to talk about its market entry into Canada and also to talk about tariffs. But we're coming to the end of a 30-day consultation already. So how much BYD can have some sway over trying to have less punitive tariffs, because it's almost a dead cert that Canada will put in some form of tariffs to kind of restrict Chinese EV imports. But we'll see. It's an interesting time, though, for sure.
All right, Danny, thank you. Danny Lee there, our Asia transport reporter on all things BYD here this morning. We're also getting some data coming through from China here. We're talking about the Taixing China manufacturing PMIs. So a bit of a miss here, actually. We're talking about a 49.8 print. So this is the first time we've seen since 2023 of a contraction on the manufacturing floor for, of course, that private gauge. So this is one that tracks smaller firms, of course, from the official gauge. But this really kind of going alongside what we heard yesterday for those PMI numbers as well.
Yeah, so relative to the forecast, this one is the biggest miss going back 2 years. So yeah, fairly consistent now, I guess, with the official numbers coming through. Wow, we didn't see this coming. A 49.8 handle on this one. Okay, we'll unpack this even further once we get more information on this and see any sort of market reaction. You are seeing slightly a pickup in dollar China, so maybe some weakness coming through in the currency here. Missing all forecasts is what we're also being told here by our producers. Okay. Now, let's take you back to the streets. We were talking about cars. We'll talk about cars even further. So the Chinese city of Wuhan is shaking off its COVID stigma to position itself as a leader in smart car technology. But its experiment with driverless taxis is also putting thousands of jobs at risk. Take a look at this video taken by our colleague, our China government reporter, Colin Murphy, who's been taken for a ride in one of the Baidu vehicles. In fact, Colum, who shot this video, as we mentioned, joins us, in fact, right now to tell us, Colum, how was the experience?
So there was like some initial hitches just trying to get a car in the first place. I mean, it does have an app, but there were restrictions on foreigners using it. But once I got over that and secured a car, it was a fairly smooth ride. I will say I was a little bit apprehensive. And, you know, the streets of Wuhan in particular are not exactly the most conducive to driverless taxis, because it's, you know, it's diverse and spread city. Traffic congestion is heavy. Driving culture is a little bit unorthodox, shall we say. So, yeah, I mean, overall it was a little bit daunting, but then as you get used to it, you settle in, you start to sit back and enjoy the ride.
What does this tell you about this race for driverless tech between the U.S. and China? Who's really leading right now? Is it really China?
Right. So it's a little bit hard to put a finger on it, because if you look at technology alone, you could probably say that the U.S. Does have a bit of a lead insofar as some of the services have been rolled out there earlier. But when you talk about actually rolling it out in a way that's integrated into people's lives, and also the regulatory framework that's in place, or the signaling, at least from the top government, the central government here, Xi Jinping, clearly indicating that, you know, high value add technology is the way to go. So that gives investors and entrepreneurs a sort of assurance, if you will, that this is definitely something that China is betting on, and therefore they are really sort of pulling out all the stops to make sure that they can get this happening as soon as possible.
Well, what's the sentiment among users, particularly residents, Colum?
Right. So as I mentioned, it's like, you know, it's quite has a history of congestion in Wuhan, although it has improved in recent years because of subways and so on and so forth. But yeah, there's a complaint from residents that the car can drive a little bit too cautiously. It's a little bit too slow, and it's even earned a nickname amongst them in Wuhan dialect, calling it sort of like a stupid or amiable kind of idiot, if you will. So, you know, there is pushback on congestion, but more importantly, there is also fears about jobs, right? Because, you know, AI taking jobs. I mean, it's already happening, as we know. People are being replaced, but what's different here is that this is very much visible. You can literally see it driving on the streets, and so of course there's concern that people like taxi drivers or ride-hailing services like Didi, you know, the people that work for those industries might end up being squeezed out of the job market. So that's definitely a concern that's been raised in parallel to the excitement about, you know, seeing this actually happening on the streets.
Yeah. All right. Great on-the-ground reporting there, Colum. Thank you so much. I know you just did a test run at a flying taxi. I'm looking forward to that report coming up as well. Our Bloomberg test driver, China government reporter, Colum Murphy, joining us out of Shanghai this morning. We got plenty more ahead. This is Bloomberg.
Right, welcome back. So we're still tracking a couple of big market themes from overnight. Obviously, you had the Fed, you had this rebound in tech, and NVIDIA obviously up, I think 13%?
Yeah.
300-something billion added. Record, which was, I think they broke the previous record of NVIDIA also coming through. So we're seeing that play out somewhat across some of the related names here. In the Asia Pacific, although Advantest, of course, that's on top of that, that's also an earnings story, so incrementally getting something slightly better there too. There's also the reporting around, of course, what it means for the SK Hynix and Samsung, and maybe more restrictions coming out of the U.S. And I think questions around what authority the U.S. then has to order the likes of SK Hynix and Samsung not to sell to. Anyway, that's a can of worms, which we can get to a bit later on. But yes, this is the chip story, and also the Japan story is also a very big one today in markets.
Yeah, I mean, Advantest is one kind of isolated earnings story. Really, the rest of the picture for Japanese equities is quite challenging. In fact, we're talking about 3% losses. We talk about the Topix, one of the biggest drops we've seen in 3 years for stocks there. It's the stronger yen, right? So we're down at such a decline. lows, I should say. 3.5% for the Topix real estate index. There you go. We're down 7.5% there. I think the threat of rising rates is certainly one thing that, maybe some of these developers are a bit more worried about, or investors in developers. But yes, I think from Ueda, why was it hawkish? It wasn't just because they did hike as well as cut down their bond purchases in half, but also signaling possible more hikes to come. That really did kind of send dollar yen dropping.
Yeah, absolutely. Not just against the dollar, against every single currency on earth. So the Topix index at the current level right now, that's now the steepest drop since the pandemic, global pandemic hit, and I think what's it verb used, roiled global markets in March of 2020. So that's the worst day in 4 years. As things stand. Very quickly, oil is a big one too. Big move up overnight on the back of potential retaliation, of course, from Iran and the developing news there. Shanghai crude is playing some catch up to the move in oil prices overnight, but as you can see, Brent and West Texas extending the move from yesterday. And we'll leave you with a look at Chinese markets going into 30 minutes into the session here. We're coming off the best day in 6 months. Some consolidation we're seeing right now. We'll unpack the PMI numbers, which came out about 15 minutes back a bit later on. The bond rally continues in the CGB space. Plenty more ahead here on The China Show. Please do not go away.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. Looks struggling to really extend that rally that we saw yesterday, which was the best day in 6 months. And really, this optimism around the Politburo meeting, according to JPMorgan, was really what was driving those gains. So the prospect maybe of some more stimulus and more maybe details on what's to come.
The acknowledgement of the issues that matter to markets, right? Cyclical weakness, some of the woes, of course. Consumption was very much part of the reason. Now, let's get to a solution, I guess, is the next thing markets are looking for, and let's get to some earnings coming through. Because the underlying state of the economy, and we just got a reminder of that 15 minutes ago, is while things are not falling off a cliff, they're not improving substantially. When you look at the Taishin PMI, which came out, unexpectedly falling below 50, matching the official numbers, which came out what's today? Yesterday. Was it yesterday? Yes, yesterday.
Yes.
And the miss, which is the bottom panel on your screens, that's the spread of the actual and the estimate. That's the biggest miss. Missed every single one of the forecasts. Biggest miss since 2022. It takes us back into markets today, and really bad data in the case, I guess, or soft data in the case of the U.S. is pushing the Fed to, well, what Jay Powell told us overnight. We'll get to that in a moment. They're 0.6%. Japan is still the culprit here as far as the drag is concerned. Nikkei Topix down 3.5%. The rest of Asia, though, is doing, generally speaking, generally well. Cable, bottom left, you have a rate decision today. I think the forecasts are mostly for a cut, but then is it one and done, and how clear is the BOE going to signal that this might be the start of more cuts, or is this an insurance cut at best? Treasuries, you talked about this earlier.
Yeah, I mean, the massive drop in yields that we saw, that's continuing. You're seeing that across the sovereigns here in the region as well. You take a look at the Aussie 10-year yield, we're down some 6 basis points or so. But that's really also the Aussie CPI print sort of effect that we saw yesterday, too. But take a look at how U.S. Treasuries are doing, because we basically capped that third month of gains when it comes to U.S. bonds. That 530s continue to be steeper. I think the steepest we've seen since 2023 here. And you're seeing basically the 2s, the 5s, and 10s are now basically back to those 6-month lows. The 1 week you basically have seen how big these declines have been across yield, 20 basis points lower for that U.S. 10-year yield. And really, it seems like Jay Powell, what he said in that press conference, that really sent this bond rally going. Here's more from that meeting.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. We have made no decisions about future meetings, and that includes the September meeting. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Let's bring in our team to talk us through the various market angles to the Fed story and more. Mark Cranfield in Singapore for us, and here on set, Stephen Chu, our Chief Asia FX and Rate Strategist. Mark, I'll start with you. Fairly on the hawkish side was a statement, but the Dovish press briefing it looks to be that what markets ran with. What does it mean for risk assets moving forward?
Oh, it's a good backdrop. Traders are convinced that the Federal Reserve has what it needs to be able to lower interest rates in September. That's what they're betting on, and they're going to continue to go with that. We do have some data coming. We've got the first jobs report tomorrow. We've got 2 inflation reports before the Fed next meet. But the path that we've seen and what Jerome Powell was talking about there, they seem fairly confident that the numbers are not going to shock them and that they will be in a place to be able to do it. He just needs to persuade the rest of the Fed people that it's time to do it. The bigger question really for traders is whether it's 25 or 50 basis points. At the moment, obviously, they're more inclined towards 25, but if the CPI numbers come in very soft, we might even start people being aggressive in pricing for the bigger rate cut. But either way, traders are not going to give up on this idea that the Federal Reserve is going to cut. That's going to be good for risk assets. And unless there's something horrible in the earnings data or some shock from outside, that is the path they're going to choose.
I think the yen traders are all breathing a sigh of relief, Stephen, in some ways. We're talking about below 150 now. How sustainable are these moves that we're seeing?
I mean, like, everything just fall into places, right? We've got the BOJ hiking rate, announcing a path of QT, so that's done. And I think the BOJ will actually hike again in October, probably bringing policy rate up to 0.5%. And yesterday, Wade actually talked about 0.5% is not a ceiling. Now, that actually gave the leeway for yen traders to basically just chase the yen rally. And now we are just below 150. Last check, below 149, right? But that's still not enough because, like, at least for our model, we are having a fair value of 143. And if you remember, like earlier last year, when market was trying to price in a BOJ normalization, we had the dollar yen near 130, just about 130. So there are a lot of room for yen to rally, for dollar yen to drop. And the Fed actually just gave what the yen traders want as well. So at least not opposing a September cut. Powell said that Powell gave what the market wants. So September to be like 25 bips is probably a done deal. Market has pricing that. Now the question is what's next? So whether it's going to be like consecutive 25, or if the CPI miss, if the job data tomorrow miss, is it going to be a 50? Now market will try to price in that. At least for now, it's basically all good for dollar bears.
Mark, can I ask you about the equity angle to the yen story and this hawkish shakeout we're seeing in Tokyo today? Nikkei's off 3.5%, volume 70% heavier than usual. What's going on there?
Well, obviously, they're not enjoying this new hawkish era of the Bank of Japan. But you can see the backstory there is the real estate sector. I don't know if you've put that up on your screen, but the real estate gauge, the Topix sub-index there, at one stage was down more than 8% today, going for its worst day in 4 years. Now, that has been a very big inflow into Japan over the past couple of years. Massive foreign inflows, buying property, commercial real estate especially in Japan. Now, it's really a disguised currency trade. So a lot of these big portfolios from around the world, they buy these chunks of buildings really because the yen was relatively cheap. The problem now is that flow is probably going to stop, and the risk is that those investment companies will want to take profit. When the yen, if the yen strengthens, as Stephen's suggesting, to the low 140s, they will seriously be thinking about when is the time for them to exit. They probably have a profit on the land cost itself because property has been going up generally in Japan. But when they get the currency in their favor as well, there's a serious risk that they'll start unwinding these investments they've seen over the past couple of years. No wonder that the real estate sector is really bringing down the whole market here. Nobody, of course, wants to rapidly see the yen appreciate in that respect, but more than anybody, it's the real estate that really doesn't like it.
Stephen, I'll get to you on the renminbi. I mean, we talk about the performance this month. It's the best month all year, really. Well, lifted by the yen, also this unwinding of these carry trades. But can we really say that this kind of slide is over? Is it just a pause right now?
I mean, you can see, like, obviously the yen is the outperformer for July and going forward as well for this month. You can see that yuan is actually just in the middle of that pack. It wasn't especially strong compared to other Asian currencies. For example, the ringgit was really strong because some state support for the currency. But at the end of the day, we have to look at fundamentals. Like, rate differential aside, which is still in favor of the U.S., because China is also cutting rates again, despite the Fed is going to cut. Fundamental is really weak. We look at the China PMI this morning, falling to contraction. The official PMI has disappointed. So we know the story. It's out there. It's all about properties, weakening fundamentals. So it's very hard, actually, for the yuan to rally on a sustainable basis. Fixing today, actually, was still somewhat unchanged. So I suspect the PBOC may want to narrow the gap between spot rate and the fixing, because then, like now, market can't say PBOC is manipulating because that gap narrows. So that's what they're going to do now.
How concerned should I be over intervention risk in the CGB market? This rally just keeps going.
Yeah, personally, I'm concerned because it's really too low. Now, market is talking about 10-year yield, for example, record low, talking about next target 2.1%. But the thing is, like, the curve is so flat now. Like, in the front end, it's still like 1.4, 1.5%. Like, it can't just drop forever. So at some point, they will have to act. Especially now, I think market start to look at the 7-day reverse repo, the policy rate, and it's still at 1.7%. So market will think, okay, so China has no inflation, so real rate is really high, positive. So they could cut rates. We'll just keep buying bonds. The mindset is basically anchored. So the PBOC will have to do something in action, not just talking, in order to reverse this. So we should be concerned.
Stephen, thank you. Stephen Chu there, our Bloomberg Intelligence Chief Asia FX and Rate Strategist. Also want to thank Mark Cranfield, our MLive strategist, joining us out of Singapore. Well, still ahead on the China show, President Xi Jinping calls for stronger border defense amid multiple geopolitical shifts. We have the details coming up. This is Bloomberg.
An update on oil markets with that massive move up in Brent, and we're looking at this over 2 days, of course. July 31st, 2-3% move there, and of course, half of 1% even further as we go into the session today. And we're not just seeing this here. WTI and also Shanghai crude's also moving quite a bit. New York Times report takes this forward, talking about how Iran's supreme leader has ordered a direct strike on Israel in retaliation for the killing in Tehran of the political chief of Hamas. Let's bring in Bill Ferries, our senior editor, to get us up to speed on this story. And Bill, if some people were largely putting this story in the back seat yesterday, it's certainly a lot more convincing now to talk about this.
Yeah, I think this strike on Iranian territory is particularly right after the inauguration of the new Iranian president. It's a huge embarrassment for Iran. It's obviously killed one of the leaders of one of their main proxy groups that's been fighting Israel. They will certainly want to respond. How they do that is going to be the real question. I mean, the things we're looking for in the coming hours, the coming days, are really both out of Iran and from Hezbollah and Lebanon. How do they respond?
Okay, Bill, I think we had just had some technical issues there with Bill Ferries. We'll try and get that sorted, of course, and just get you guys back. Yeah, and we're seeing that play out in the oil markets today.
Yeah, you got to wonder just how forceful this retaliation is going to be, as Bill sort of foreshadowed there, because back in April, when they did do that attack, it was very well telegraphed.
Right.
And it was very well communicated that they were going to do so to avoid any sort of big escalation in tensions as well. So is that sort of be the strategy this time around? But then again, they're also questioning, how did this happen, right? Is there a big question here of the safety of their most senior state officials and allies now, and what can they do next?
On shore,
yes.
Right? And that's the other key question. I think Bill was about to get to that point that you were just making there. That for the first time, fine, we understand that you do need to show the world a response. The second time, though, can we expect the same sort of mechanics and dynamics at work? And if you look at some of these reports on the back of what happened, I think it was mid-April, of course. They're well telegraphed, and in fact, I forgot where I read this. Like in some cases, the U.S. of course also came, I believe, to the defense of Israel to shield it from all those rockets. In any case, of course, we'll talk more about this, and we'll try and get Bill sorted and hopefully continue the conversation there. But yeah, just ahead here too.
Yeah, you look at the market reaction. Obviously, oil markets. We talk about how elevated they could be. We also have the OPEC meeting coming up as well. Keep that in mind about what this means for production and the like here. But also when it comes to, there is a little bit of that flight to safety into the havens as well. So gold is catching a slight bit here. So certainly when you deal with the central bank discussion, certainly that's good for risk assets. But you also have to think about now the geopolitical risks as well. There you go. And dollar yen. You are seeing a little bit of those haven flows. Maybe that's part of it as well into the yen strength. Coming up, we're going to talk about the Biden administration set to weigh unilateral restrictions on China's access to AI memory chips. We look at the implications coming up. This is Bloomberg. All right, we're looking at tech. We're looking at chips here this morning, and really you're continuing to see this rally underway. Part of it is with what happened with NVIDIA overnight with that 13% pop there. Obviously, with the Fed story, and that certainly has reignited this tech trade once again. And there you see it. SK Hynix is up some 1%. Taiwan Semi also doing quite well here today. And this is on the backdrop of a Bloomberg scoop as well. The U.S. is said to be considering new restrictions on China's access to AI memory chips and equipment, a move set to further escalate their tech rivalry. For more, let's bring in Min Lo, our China correspondent. Tell us more about these latest measures.
Yeah, these are really targeted at the high-end chips required for AI, the HBM, the high bandwidth memory chips required in those AI accelerators offered by companies like NVIDIA. And so the most dominant companies making these HBM chips are the likes of Samsung, SK Hynix, Micron as well. So if these new rules are enacted, then these companies will not be able to sell their chips as well as the chip-making equipment to China. And this is likely to be an expansion of that FDPR, the Foreign Direct Product Rule, that allows Washington to impose controls on foreign products that have even just the tiniest bits of American technology. And we know Samsung, SK Hynix, they rely on U.S. chip design software, while Micron, though, is not likely to be so affected because it has been refraining from selling these HBMs to China after Beijing had banned Micron from critical infrastructure in China. At this moment, we know China already has the ability to make the HBM2 chips. Changxin Technology is that Chinese company that can make that. So these curbs are aimed at curbing those advancements in these tech frontiers. And the Biden administration is also planning to impose sanctions on over 120 Chinese companies, designating them as a national security threat. And they're also looking to compile a list of critical components that China will need to make these semiconductors.
Right. Now, let's talk about exemptions or potential exemptions here, because the market's trying to gauge what the revenue hit is going to be to many of these companies. And we understand that's probably possible with some key allies like Japan and the Netherlands. What would be the considerations there then?
Yeah, so Reuters first reported this, and our sources are saying that the U.S. is considering exemptions to maybe 4 or 5 countries. We don't know who they are, possibly Japan and the Netherlands. It's likely because these companies are pushing back because China is a huge market. And there's also the flip side, the likelihood that maybe this could backfire as well if these companies then go on to find alternative sources of technology to cut out American technology in their supply chain. But regardless of which are the companies, the countries that are exempted, this is likely to be quite a very broad-based restriction that will affect many countries, including the likes of Singapore, Malaysia, Israel, Taiwan as well. And this is coming after American companies have been pushing back, saying that these U.S. restrictions are affecting them disproportionately when the Chinese firms can still rely on technologies outside of the U.S. And that's why the U.S. have been trying to bring more countries into this fold to create a more multilateral framework for these tech restrictions in China.
Min Lo, thank you, our China correspondent there on the latest on that Bloomberg scoop. Let's stick to those chips and what's really been going on. We're focusing on TSMC in particular, right? Actually seeing a record number of retail shareholders this year as it sparks patriotic spirit among Taiwanese investors wary of China. Let's get to our Taiwan markets reporter, Betty Ho, joining us now from Taipei. Betty, it's good to see you. What's going on here?
Yeah, so on the ground in Taiwan, we are seeing a record number of retail investors buying into TSMC stock because basically they believe that the best thing that they can personally do to protect Taiwan is to invest in this great company that they call the holy mountain that safeguards the nation, or the Silicon Shield. And they call it that because TSMC's unreplaceable role in the global tech supply chain, and also because of the fact that it is such an important element of the local economy and the local stock market. So in 2022, TSMC alone accounted for around 8% of Taiwan's entire GDP, and its weighting in the TAIEX is also over 30%. So it is very essential to Taiwan, and that's why retail investors are investing in the company in order to protect the island.
Now, what are the risks here, though?
Right. So we talked to fund managers, we talked to some institutional investors, and they are already saying that after the 58% stock rally this year, TSMC, the price earnings, the forward earnings is looking a little bit elevated compared to the 5-year average. So investors do have to be aware of that, and also the fact that the stock is still largely held by foreign investors. So the foreign investors holds around 70% of the stock. So if they decide to sell off, it will definitely hurt the retail investors as well.
All right, Betty. Thank you, Betty Ho. There, our Taiwan markets reporter joining us out in Taipei. The Holy Mountain. What is this? The Holy Mountain.
What are you talking about?
No, this is what they call it. TSMC.
Okay.
The Holy Mountain safeguards the nation. Yes. Yeah, but certainly does it safeguard you from those sky-high valuations? That's a big question, right?
Yeah, mountain.
Mountains.
Mountain.
Yeah. Other stories that we're tracking for you today. Bloomberg has learned that Applied Materials will not be receiving U.S. funding for a long-anticipated research and development center. Sources tell us that the U.S. Commerce Department rejected its application for $4 billion in the CHIPS Act money, saying the project did not qualify. Applied Materials had said the California project would have been the industry's biggest R&D facility. And a quick recap of the tech earnings that we got overnight as well. AMD giving an upbeat revenue forecast for the 3 months to September after results in the second quarter topped expectations. It's citing strong demand for its so-called AI accelerators, which are the chips used to develop AI models. Meanwhile, Qualcomm's post-market rally sputtered out on concerns that the smartphone market is recovering more slowly than investors had hoped.
Now, Meta second quarter sales there were a beat, in a sign here that investments in AI are helping it sell more targeted ads. In the meantime, those shares in ARM fell in late trading after the chip designer here held off on boosting its annual forecast, and that, of course, comes despite quarterly numbers easily beating what the street had been expecting, at least.
Yep. In terms of what we're looking at from movers in Hong Kong today, there's still some earnings that we have to kind of go through as well. Budweiser, we saw basically shares falling here this morning after profit did miss. They did also cite soft China demand as the culprit there as well. East Buy Holdings, that's one to watch, as given what we saw with New Oriental, that stock dropping quite substantially here as well. Those two are somewhat in partnership and the like here, so that certainly is impacting East Buy. And Hang Seng Bank as well, those shares falling after earnings. Citi seeing some credit risk involved. The next one is one we all want to talk about, right? K-drama stocks are so excited. Season 2 of Squid Games is announced. Do we know what day it is?
Yeah, December 20, so the day after Christmas.
Oh, what a nice Christmas gift.
And yeah, I mean, while you wait for Santa and the gift that never came, this is probably it. And here's what's happening, too. There's a third and final season that's also coming in 2025. So you have two more installments of this one.
Gives me enough time to mentally prepare for it.
Yeah?
A few more months.
That was a bit intense, actually. I went through this one Saturday, one entire Saturday.
You just binged it in one go. Not a good idea.
I took Monday off to recover. I'm waiting for season 5, though, of Emily in Paris. No, I'm not.
Yes, you are.
Well, how long is she in Paris for?
I don't know.
There have been
she
elections.
has to wait till after the Olympics.
There have been
before she
Olympics.
leaves.
There's probably another rate cut coming. What is Emily waiting for? Anyway.
All right. Global macro movers are doing this here right now. As we, of course, we wait for all those TV shows. We can watch these markets here. Really continue to see that risk asset rallies here, with the exception, of course, of Japan and Singapore here right now. But certainly that dollar drag is helping and sustaining here in this Asia session. And really, it looks like stocks and bonds are doing quite well post Powell press conference. We got plenty more ahead. This is Bloomberg. 11:29 a.m. in Tokyo. We are still digesting, I guess, that BOJ meeting, that press conference in Ueda-san here that really is continuing to roil Japanese markets here this morning. I'm talking about the stock market, and really the declines that we're seeing across the board is certainly given what we've been seeing in the yen, right? So that yen is basically back to levels that we haven't seen since March. We're at 149 levels here right now. We're off some of the lows in the Topix, but still we're talking about 3% declines here, and yields are heading slightly lower in the JGB market here today. Where we're seeing most of that pain is going to be in the real estate sector. Those stocks are basically have plunged this morning. You take a look at some of these real estate stocks as well. Sumitomo Realty down some 10%. So the prospect of possibly that more hikes to come certainly is challenging the sector here this morning. The overall Topix real estate index down some 7%. But Dave, put some size and scope on this sell-off a bit.
Yeah, it's clear that, I think to your point, right, rate-sensitive sectors are reacting the most really to what now appears to be maybe slightly more hawkish BOJ, and the market was not expecting the shakeout coming through. So it might take a few days, because when you look at things like, well, the price itself, this decline of 3.5%, we haven't seen a day like this in Tokyo going back 4 years. And what happened 4 years ago on that side of my graph is when the pandemic first hit and just caused global markets to just go haywire and central banks to floor rates, and yet here we are looking at this. And in terms of market breadth today, every sector, I believe, is down in the Topix index, right? So everything from marine transport all the way down to Yvonne's point, your rate-sensitive sector in real estate. Now, as far as volumes go, and perhaps an indication that today might just be the start, and who knows, by the way, how long this lasts after today, volumes are coming in substantially heavier than usual. So at the moment, we're going into the lunch break, we're 60% heavier than usual, and if you extrapolate that to the end of the day, we could actually see a 3 billion share day over on the Topix index, which you don't normally see. What we normally see is about 1.7 billion. So this is maybe about double. We'll see what the asset in session looks like. If it's anything like the morning, close your eyes if you're a stock bull. Fun.
Yep, and we're looking, of course, and continuing to look at those rate-sensitive sectors, particularly when it comes to financials and shares of Mizuho now. The third largest bank in the country has reported a better-than-expected increase in its first quarter profit. For the details, let's get to our Asia investing editor, Russell Ward. He joins us live from Tokyo. Russell, we saw these Japanese bank shares jump the most since December 2022 on the news of that rate hike from the BOJ yesterday. Why do you think investors are so positive on the banks now?
Morning, Yvonne. Yeah, you just mentioned how there are rate-sensitive stocks in Japan, and certainly for the banking sector, it's a positive thing. Obviously, they've been languishing under negative rates for many, many years. That ended in March, and now they've got the prospect of, well, a second rate hike and even potentially further rate hikes down the road. That's only going to help banks' lending profitability. And so we had Mizuho report kicking off the earnings season for the Japanese banks, the first bank to report in a post-negative rate era, and its profits beat estimates. It's actually reached almost 40% of its annual target after just one quarter, and that was actually partly helped by lending income. So we're already seeing just some signs of, the lending income getting a bit of a tailwind from higher rates. And we saw just an announcement yesterday from Mitsubishi UFJ planning to raise its short-term prime rate for the first time in 17 years. Now, this is a rate that's used as a benchmark for mortgages. That's getting back to the real estate stocks. That's probably why the real estate stocks are down, because that's going to put the brakes on the housing market here, but definitely a tailwind for banks and a tailwind for the lending profitability.
Russell, speaking of Mitsubishi UFJ, the company is reporting today, if I'm not mistaken, at about the close. What are we expecting?
So MUFG is actually expecting to post lower profit, but that's just because of the absence of a one-time gain a year ago. We're expecting MUFG to basically follow Mizuho and report solid progress towards its full-year profit goal. MUFG is forecasting 1.5 trillion yen in profit this year. That's a record. And so, as the year progresses with the higher rates in Japan, MUFG and other banks are going to see, as I mentioned earlier, lending income getting that tailwind, and that's really going to benefit MUFG and all the other banks. And we'll have to see, whether there are some signs of that coming through in the earnings when they report later today.
Yep, and we also got Norin Shuken. This is, of course, after it announces massive losses expected on sales of its foreign bonds. What's expected there too, Russell?
Yeah, so with Norin Shuken, higher rates have actually been a bad thing, a very bad thing for the bank. In fact, this bank has got quite a different business model from the other banks. It really acts like an investor, and so it piled into foreign bonds when rates were very low in Japan, and of course those foreign bonds have lost their value as the Federal Reserve and other central banks raised rates. Its funding costs now exceed the return that it gets on those foreign bonds. So it's cleaning up its balance sheet. It's forecasting 1.5 trillion yen in losses this year, which is actually coincidentally the same amount in profit that MUFG is forecasting. So the contrast is quite stark there. So we'll see some signs. We'll have to see, how much of that loss showed up in the first quarter and how many of those bonds it managed to offload. We'll also get an update on their paper losses, whether they've changed much from the previous quarter. And also, lastly, they're going to update on their capital raising plans in order to plug these paper losses. The farming bank is going out to its co-op members and seeking a capital injection from them. So we'll have to see how much progress they make on that front.
Russell, thank you so much. Russell Ward, our Asia investing editor in Tokyo. For staying on earnings, UOB, United Overseas Bank shares are down 0.4% in Singapore. Out with second quarter results here. So Southeast Asia's third largest lender says net income excluding one-off costs fell by 1% to around $1.1 billion US dollars, that is. But a decline in its main lending income was cushioned by strong gains from fees, including from wealth management and also credit cards.
And we'll be hearing from the UOB's group CFO about their results and, of course, a Fed cut expectations. We'll also be speaking with Rio Tinto's CEO for the outlook for the world's second largest miner after the firm did see its first half profit edge higher. Plenty more ahead. This is Bloomberg. All right, just want to recap some of the data that we got. That Caixin PMI number out of China was not pretty here. We're actually seeing it dip for the first time in 9 months. So we were seeing a 49.8 level there. Obviously some concerns, but it's interesting, right? We used to see this sort of difference between the private gauge and the official numbers, where the private gauge was actually stronger than the official numbers before. Now it seems like they're showing a similar trend of late. And Bloomberg Economics is coming out with their latest report saying Caixin is right when it comes to the contraction, wrong when it comes to the speed.
Yeah, and that takes us into now some of the other PMIs which came out, I think, about 2 hours back from across the region. So you have a couple of countries on your left and economies, and you have, of course, the prior. And on the right are the actual numbers coming through. So just keep in mind these are diffusion benchmarks, right? So compare them to the last month is helpful, to say the least. Anything that stands out? Not so much. Japan, 41.9. Yeah, but Indonesia, back in contraction there. Right, let's get a sense of where EM Asia is and maybe what the policy signals are for central bankers in the region following the Fed almost signaling as much that rates are about to come down. Joining us here on the set is Molly Chivakul, emerging markets economist at Bank J. Safra. Sarasin, nice to see you. Good morning.
Good morning.
What's your assessment on China right now? This recovery, when is it going to happen?
I think it's going to become increasingly difficult for China because, as the PMI has shown, in the last few months, they have been relying quite a lot on exports. We have already seen that is basically coming down. Even though, earlier we thought that this is going to continue in the second half of the year, at least there should be some pull forward in terms of the preparing before the potential tariffs next year. But now, the PMI is showing that it is already slowing down. So I think it's going to become more difficult for the government to be able to meet this growth target around 5%.
We had a guest earlier that said, markets are very excited about this Politburo meeting, what came out of it. We're finally hearing some details when it comes to how to boost consumption, fiscal spending, the like. Do you think are you just as optimistic about whether more stimulus is to come or not? Yeah,
I saw the market reaction, but I think when we look at the Politburo meeting readout, it's just showing that they repeat the same words, as before. We have seen this before. They just kind of put it a little bit higher on the agenda. But then there's no really any detail on whether they're going to spend more. We think that they have already set out these long-term bonds, which we think that they can ramp up for the year. If they issue more, that could help somewhat for the second half of the year. But on this consumption, I think it's going to be quite difficult because we don't have that much time. Right? So they will need to roll out something very soon to be able to really prop up the sentiment, because that sentiment is very poor now.
Yeah, to your point, right? Confidence is very hard to measure. It's very hard then to offset. And to your point on some of the demand side solutions that they have put forward, I think we did get a little bit more detail on the replacement cycle for white goods and appliances, some subsidies for the cars. And it seems like, and we have rate cuts too.
Yes.
It seems that there seems to be a coordinated response that's shaping up. Are we underestimating the policy offset that China could come out with over the next few months?
No, I think if they really would like to pivot, they could. But I think they still seem a little bit reluctant to really get into, boosting consumption very clearly, even though, it has it basically, I think they do not have much time, and what they have been doing, which is more supporting on the supply side, is not really working anymore, and it has actually this deflationary pressure on the economy, which also means that, for households, employment outlook, income outlook is just not very bright. Yeah. And given that, then, you are not going to consume more. So you need to basically prop up some of that with the measures.
What does this mean for the rest of EM Asia? We just saw those PMIs out for some of these EM economies, and North Asia is still looking pretty strong, whether it's chips exports or the like. Can they sustain this manufacturing growth despite China slowing?
I think there's very different among the economies, right? The North Asia, as you said, is relying mostly on the chip exports, on the AI cycle. And I think that could continue for quite some time because there is still, I think, a lot of demand for this. But for China itself, in terms of importing from the rest of Asia, there is not so much at this point. So we see more of the imports on the commodity side. So you can see a little bit more support for Indonesia, for Malaysia, but not so much of the rest.
Now, that takes us into maybe the Fed and maybe some central banks in the region that were waiting for a clear signal from the Fed. They were holding off on cuts. Maybe now they could. Did those central bankers get any better clarity on when they can move on rates lower in the region?
Yeah, I think so. I think the Chair Powell was quite clear with his hint yesterday, and I think at least the central banks in the region will become a bit more comfortable with how market pressure will likely be less on their currencies. I think they'll still have to wait and see a little bit in terms of the U.S. data, and if there are any surprises before September. Plus, you also have the elections coming, so I think there's a bit of a wait and see mode. And for some country where you have the interest rate differential much higher than the others, then a quarter basis point is not going to make a huge difference, right? If you are closer, then maybe it makes a difference.
Wait and see until when? Can they still sneak in one rate cut this year, you think?
Yeah, I think some can do by Q4.
Right. Which ones?
I'm looking at Korea, for example.
Okay.
I'm looking at India. India, it might depend a little bit on the food prices. But for Korea, they have already thought about it, and the governor has actually discussed this. Sent some signal, and the economy is actually cooling down quite a bit on the non-export side. So I think they have some room.
What about Thailand? Because we know one group in Thailand really wants the central bank to cut, and that's the government. Do you think they'll be able to cut rates this year?
I think the Bank of Thailand is still quite concerned whether this pending digital wallet launch is going to create more inflationary pressure, and whether they will be spending too much on the fiscal side, which has some implications on the monetary side. And I think they will hold on to it for now until the launch is clear and they can see the effects. So I'm looking more for more like a next year Q1, Q2.
Okay.
How are you looking at the U.S. election? Obviously, there's that tariff threat that could impact this whole region. China is definitely one, but what about the rest?
No, I think it's there are two types of tariffs that Trump has talked about, right? So there's on China, which now it's already 25%, could go up to 60%. We don't really know where exactly it's going to land, but it will be higher. On the rest of the countries, there are talks of this 10% universal, which will hit pretty much all the countries that have increased their exposures post-trade war 2018. And we're talking about Vietnam, we're talking about India, Thailand, Korea, Taiwan, all of them. So yes, I think there will be quite a bit of impact if the tariffs are really coming.
Yeah, I think if I remember correctly, during Trump's first term in 2019 amid the trade war, we did get an acceleration of companies diversifying their supply chains. And I'm wondering if we do get Trump 2.0 and we do get more tariffs, do you think we will get more companies looking to diversify their supply chains? I mean, in other words, which countries do you think might benefit even further from that potential inflow of FDI?
Yeah, I think for the same group of countries could still get more FDIs, especially from China, where the Chinese companies set up basically plans for in the third country trying to avoid the tariffs. But then it also depends on how the U.S. is actually reacting to this, because there are also talks, for example, in Mexico, where Chinese companies have gone to, and then there are talks that if the components there are too much coming from China, then it maybe not work in a sense that they might not be able to avoid the tariffs.
Molly, it's great to have you. Molly Chivakul there, emerging markets economist at Bank J. Safra, Sarasin. Coming up, Beijing names a new army commander to oversee the South China Sea after recent clashes inflamed tensions with the U.S. and its allies. We have more on that coming up next. This is Bloomberg.
Welcome back. Here's your China brief. For today, a look at what's making headlines in national newspapers. There, President Xi Jinping's call for stronger border, coastal, and air defense is dominating coverage across state news outlets here. The party's official mouthpiece, People's Daily, has several front-page pieces about strengthening the military. Now, Xi gave the message ahead of today's 97th anniversary of the PLA. That's the People's Liberation Army, also known as Army Day. Now, he reportedly noted opportunities and challenges for China's borders as the global landscape changes.
And China is flexing its military might in a documentary airing in time for that PLA anniversary. Its producer, the international broadcaster CGTN, says the six-part series showcases the PLA's reform and modernization. The first episode features the Navy and key achievements, including the commissioning of China's first domestically built aircraft carrier. And that call from Xi and the media's messaging about the military is coming as tensions simmer with China's neighbors. Let's get to our Asia government and economy correspondent, Rebecca Chung-Wilkins. She's with us here in our Hong Kong studio. So what prompted this call from the president?
Well, as you say, not an enormous surprise, right, given the backdrop of border conflicts that China has right now. So think about that India conflict, a very bitter dispute over the border there, going back to 2020 when we saw soldiers on both sides lose their lives. It's the reason that India-China relations have been rocky, really, for the last couple of years, or there's a struggle to get that back on the road. Look at the South China Sea. So in some ways, I think the message itself, not entirely surprising that China would be looking to sort of strengthen its borders. But the timing is significant. And of course, the very public display, as you mentioned, across a lot of Chinese state media. Today is the 97th birthday for the PLA as the CCP marks it. So that time is significant. We're also into that period where we may see Beidaihe. This is a sort of annual conclave of party elders that meet typically in August, so we're coming up into the run-up for that as well.
Yeah, speaking of South China Sea, Beijing has appointed, fairly abruptly if I'm not mistaken, a new commander there. What do we know?
Yes, and this looks to be significant for two reasons, really. The first is the location. South China Sea. I mean, most analysts, aside from Taiwan, would probably identify this as the riskiest or the most important flashpoint for a potential hot conflict in the Indo-Pacific, primarily because since Ferdinand Marcos came to power, he has really shifted the relationship with China. The Philippines now is pushing back on nearly all of China's claims in that part of the world, and of course has moved much closer to the US. We have agreements to open US naval bases and so on in the Philippines. And so these clashes between Chinese and Philippine vessels have intensified in recent months. And so there's a lot of focus on that part of the world. The second sort of significance is really the backdrop against this happening. We have very little details. I should caveat that heavily. We have no idea really what happened to the predecessor of this commander. Could be, of course, all above board. But because of this corruption scandal that we've seen, this investigation going on since the last summer, at least 16 senior military officials have been removed. We also know his predecessor was age 60. The typical de facto age for retirement is about 65. So very, very hard to speculate, but that backdrop, I think, adds significance for folks sort of really closely trying to make sense of a little bit of how China is thinking about some of its military disputes on the one hand, and also how it's dealing with sort of domestic issues as well.
Rebecca, thank you so much. Rebecca Chin-Wilkins, their Asian government and economy correspondent. Back to markets, and just an update on Japan. We are on the lunch break over in Tokyo, but futures are still reflecting this really massive move to the downside here. Nikkei and Topix futures, as you can see, off still 3.3%. And your two-year yield, and the move we're seeing here where we are, I think 2008 highs here on the two-year yield, reflecting not just the rate hike yesterday, but the potential for more coming through out of the BOJ, and certainly with comments coming out of Ueda-san that 0.5% is not so much a ceiling, fueling this hawkish trade in Japan. Dollar-yen has now a 149 handle there.
Yep, so that's still one thing to deal with. The next thing is the Bank of England, and really what you're seeing here across markets is that there's increasingly more of that tilt towards maybe the BOE is ready to cut possibly today here. So we're seeing sterling at 128. FTSE futures are slightly pointing positively here this morning. Still watching, of course, the impact on the yen. So pound sterling yen, I should say, is on 192 right now. It's going to be a close call, they say, because first they're going to talk about the possibility, and then what's the guidance going to be? And Bank of England Governor Andrew Bailey is going to be breaking his silence after this election. So we're going to get that press conference just 30 minutes after that decision.
So for Bloomberg clients, you can tune in to, you can go to, of course, your Bloomberg T Live Go commentary and analysis on this upcoming risk event across these markets. That's it from us here on The China Show. We'll see you all tomorrow. Bloomberg Markets Asia is just ahead.